So let's look at what diversification means and the importance of keeping a diversified portfolio.
Today, we're going to dig into the very foundation of modern investing. We're talking about a theory that's been around for over 70 years. And we're going to look at a powerful new alternative that might just completely change how you think about building a portfolio.
So let me just start by asking you a question. Is your investment strategy stuck in 1952? Seriously, because there is a very good chance that the portfolio sitting in your retirement account right now is built on a rulebook from that exact year.
So, to figure out where we're going, we first have to understand where we've been. Let's crack open that 1952 rulebook and talk about a little something called modern portfolio theory. All right, so modern portfolio theory, or MPT, was dreamed up by a guy named Harry Markowitz back in 52. And at the time, believe me, it was revolutionary. I mean, for the first time ever, it put a real, rigorous statistical framework around investing. The goal? Well, it was to squeeze every last drop of return out of your portfolio for a certain amount of risk. And this is the crucial part. It defined risk as just one thing: price volatility, how much your investments bounce up and down. And boy, did MPD take over. It didn't just make a splash, it became the entire ocean. From its publication in 1952, it went on to become academic dogma, and then, inevitably, the industry standard for pretty much everyone. For more than 70 years, it's been the undisputed king of how we build portfolios. But as you can see, today the ground is starting to shake. But even a king's crown can have some cracks in it. And that brings us to the real problem. What happens when the neat and tidy world of statistics just doesn't line up with reality? And here it is, the fundamental issue. MPT is beautiful on paper, it's mathematically elegant. But that elegance came at a huge cost. In its search for statistical perfection, it basically disconnected finance from the real world economics of actually investing. It started treating stocks less like ownership in a business and more like abstract data points in a spreadsheet. You see, MPT's tidy little bell curve model really struggles with the sheer messiness of actual markets. It has no real way to account for black swans, those sudden, out of nowhere events that change everything. It also ignores something statisticians call fat tails, which is just a fancy way of saying that extreme, crazy market moves happen way, way more often than the model thinks they should. MPT just wasn't built for that level of chaos and uncertainty. Okay, so if the old model is starting to look a little shaky, what's the alternative? Well, let's introduce the new challenger. It's a framework called Marginal Efficiency of Equity, or MEE. And it all starts with a very simple idea I like to call the next dollar test. This slide right here gets straight to the heart of it. The two philosophies are just worlds apart. MPT is obsessed with minimizing those statistical ups and downs, that price volatility. MEE, on the other hand, is laser focused on something way more intuitive, something a business owner would get instantly: maximizing the actual return you get on the capital you invest. It really all boils down to one single, incredibly powerful question, a question that any entrepreneur would ask themselves every single day. If I have one more dollar to put to work, where is the best place for it to go? What's the return on that next dollar? That's the whole game. Now, this chart might look a little intense at first glance, but stick with me. The idea is actually super simple. Each of those lines is a different investment opportunity. And notice how they all slope downwards? That's a fundamental law of economics called diminishing returns. The more you invest in one thing, the lower the return you get on your next dollar. So Emmy's logic is just brilliant. You fund the best opportunity, that top line, but you only do it until its return drops down to the same level as the second best option. At that exact moment, you start funding both of them. You're always making sure your money is going where it will work the hardest for you right now. So let's just break that process down. It's so logical, it's almost beautiful. Step one, you rank all your possible investments by their MEE. Step two, you put money into the best one, but only until its return is no better than the next guy in line. And step three, you just keep working your way down the list, allocating capital. Diversification isn't some separate goal. It just happens naturally as your best ideas get filled up. All right, time for the main event: MPT versus MEE. Let's really put them head to head because we're talking about two frameworks that are at their very core completely and totally opposed. Let's just go down the list. Risk. MPT uses statistical variance. MEE uses something we all understand intuitively: opportunity cost, the return you're giving up by not investing in the next best thing. Returns. MPT is looking at historical averages. MEE is focused on the efficiency of your very next dollar. How do you build a portfolio? MPT uses complex black box optimization. MEE uses a simple, logical ranking system. At the end of the day, one is built on a fragile assumption that returns fit a perfect bell curve, and the other is built on an iron law of economics, diminishing returns.
And if you're looking for the mic drop moment, well, here it is. This is the fundamental theorem of diversification, which is the cornerstone of the MEE framework. And it's a bold claim. It says that if you follow this logic, if you always allocate your capital to the highest marginal returns, your portfolio will outperform portfolios that are diversified using any other method. It's completely reframing diversification, not as just a way to reduce risk, but as a way to actively optimize your returns.
Okay, so this all sounds really good in theory, right? But what does it actually look like in the real world? Let's take a peek at what the MEE framework looks like in practice.
So, because MEE is grounded in economics, not just abstract math, it can handle all the messy, real-world stuff that MPT just has to ignore. We're talking about things like the cost of your capital, how much leverage you're using, corporate buybacks, even your own personal preference for having liquid cash. All of these things can be built right into the model.
And here is what it can look like when you put it all together. This isn't some black box spitting out numbers based on historical correlations. It's a planner that helps you allocate your capital based on real economic efficiency, ranking your options by their marginal returns, and building a portfolio from the ground up, brick by brick. At the end of the day, MEE is really about a return to common sense. It's about bringing diversification back to what it should have been all along, that perfect meeting point where the economics of a business and the strategy of an investor finally come together. And that really leaves us with one final and I think pretty important thought. If your entire financial future is being navigated with a map that was drawn 70 years ago, isn't it at least time to stop and ask if maybe, just maybe, the world has changed? And whether you might need a new map to get where you're going?
Okay, let's go back to our discussion. Again, skipping the quiz. And let me bring here the, okay, this. But before this, let me, we saw in the short video that the so-called modern portfolio theory began in actually the year I was born. So I have the same age as this, as the MPT theory. And I actually liked it, not just because we share a birthday, a birth year, no, not the birthday, but a birth year, but because I taught it also for many years at university. So I'm very keen on the model portfolio theory. But I had a problem when I started investing in working with real portfolios. I realized that the MPT didn't work very well. And didn't work very well because most of the risks that an investor faces are really not volatility risk. So the volatility risk is not the, a risk like the risk of a company being delisted, risk of a bad news affecting the reputation of a company, you name it, the risk of the market being a bit out of the this world and so on. See, these are all or valuations not being reflected in the market and so on. So these are the real risks or the most common risks that investors face. So I began wondering what can we do to somehow address these issues. Okay, if volatility is not really the most key important from a perspective of a practical perspective, let's see what we can do. Then I came up with this idea of the marginal efficiency of capital, based, of course, on what we teach and learn at microeconomic courses, which is the law of, and it's one of the probably fundamental laws of economics, which is the concept of diminishing return. So the more capital we allocate to a given to a given stock, of course, the efficiency of that of its deployment will be declining. So so I basically start looking at this type of things we have here, but I realized that if you compare the marginal return with the average return, then this is not probably the best way of looking at it. In particular, we cannot. It doesn't include the possibility of this curve being shifted either outwards or inwards. And so what I thought is, why not have a system where we use the marginal efficiency, which, by the way, is more difficult to calculate than the in terms of optimization technique, we use exactly the same optimization technique as the MPT. MPT uses the mean reversion model, which is based on linear programming. We also use linear programming to define to solve our equations. So we use the same optimization technique. So there's no difference there between MPT and MEE. Is the same, but the estimate of this marginal efficiency is where we can bring in those so-called risk factors that are not part of the volatility story, and then we can add them. So I built this alternative where we look at the marginal efficiency for alternative stocks. We have here a number of stocks listed with their respective MEE curves, and the solution for allocation on this for these stocks is, of course, based on one thing, and that thing is that the investor budget. So will invest as much as of each in each company as our budget allows it. And to solve that, then of course we have to solve so-called budget clearing or cutoff return rate. Here expressed as a ratio, not as a rate. So it has to be -1 if you want to use rates. And using this approach, then we can find what the optimal allocation among these, I don't know, 1, 2, 3, 4, 4 stocks we have here. Actually, just 3, 4, yeah. Okay, so basically we find this budget clearing rate, and from this we can, of course, analyze a bit of other risks, the ones that will shift any of these curves inward or outward. Among those risks, there is a problem of, for instance, leverage. Do we want to use leverage or not? If we want to use leverage, we change, of course, to the budget clearing cutoff rate of return. Do we want to use? Do we think that some of these stocks are mispriced? And if they are mispriced, then we would need to shift the corresponding marginal efficiency curve accordingly. Do we want to enter into account the liquidity? Of course, we can also enter into account the liquidity required. Do we want to take into account share buybacks? Then we can also add the share buybacks here. Okay, so good, so far so good. But the problem is that there is a difficulty in doing including all these factors into this type of model. So for practical reasons, in the SADIF platform, we just looked at the intercept point, and we just rank the stocks and the allocation of the different stocks based on the intercept. We didn't went far enough to consider all the other things. But from a theoretical point of view, of course, this is much superior to the traditional modern portfolio theory. From a practical point of view, unless we made some assumptions like this assumption we are doing in our platform, which somehow makes it seem a bit close to the Markovich solution. So we we don't claim to be a major practical departure from, it's just an alternative way, not really a major practical depart. So let's just give you a small example of then of the how we look at diversification in the platform. But let me remind you also that before people starting trying to optimize a portfolio, portfolio diversification was already very, very common. So based on the principle that we should not put all the eggs in the same basket, which has been a principle in banking, for instance, to setting limits, and the same in portfolio construction. We have been doing that for centuries, I would imagine. But the idea of really optimizing the size and the structure of a portfolio is the one that is more recent as my age, as you realize. Okay, so moving fast, trying to move fast, I will just show you, let's show you what we have in our platform and how you can use it. And here I need to go to the selection, select a country, let's say Australia, for instance, and select here a period, 26, okay. Let's just select some stocks. Well, let's put here some, just an example, just to exemplify. Let's imagine that our portfolio of 8 stocks was included these stocks. So in Australia, and let's see how we would look at diversification and weighting in our platform. Just quickly, okay, we have here the results, and you see that we have here different weighting methods: equal weighting, capitalization, Henry Markowitz, Marquez Mendes, which is the MEE, and SMR. So we have this. We could have a few more, but I think these are enough. But you see that we then have the return based on the different weighting methods. Here, the best one in terms of return is capitalization. Yeah, but we could look at the risk adjusted using Sharp or Trainer. We can also look based on alpha. So one need to consider is how we are going to use this information on the past efficiency of these weighting methods to improve our portfolio. Okay, and this is critical because in a different study we did some years ago, we realized that actually the choice of diversification explains about 1/3 of the performance of portfolio. So it's quite a fundamental issue, but unfortunately we don't have a clear answer to say you choose this or that. Is somehow based on empirical knowledge and your own experience. So, but this doesn't diminish the importance of having a diversified portfolio, and this is a must of any portfolio if you want to succeed in portfolio management. Okay, so already too much time has taken already exceeded my time, so we have to finish here. And I wish you a nice evening, and tomorrow we'll come back again. Okay, thanks for listening. Aí, falhou. Espera, não, Sofia, ainda não consegui desligar isto. Ainda não consegui chegar ao. Ai! Eu não consigo. Agora não estou a conseguir chegar a. Acho que é aqui. Ok. End meeting.